Good day everyone. So now let's proceed at fair value. So according to the book, fair value of an asset is the price that would be received to sell an asset in an orderly transaction between market participants and the measurement date. So fair value also refers to the actual value. Actual value of an asset It may be a product, a stock, or security that is agreed upon by the both seller and the buyer. Agreed upon seller and buyer. It is also applicable to a product that is sold or traded in the market where it belongs or under normal conditions. It is determined in order to come up with an amount or value that is fair to the buyer without putting the seller on the losing end. And also, these market participants which are the seller and the buyer must be independent, knowledgeable, and willing, meaning they are not forced to enter in the transaction. So simply stated, that fair value daw is yung presyong napag-usapan at naagrihan ng buyer and seller at the date measured. Quoted price is the most recent price at which an investment or any other type of asset has traded. It represents the most recent bid and ask prices that buyers and sellers were able to agree on. More often, the fair value or securities is the quoted price in the securities market, for example, the Philippine Stock Exchange. If the quoted price pertains to a share or equity security, it means pesos per share. For example, the investment in 15,000 shares of an entity costing 700,000 is quoted at 90. So, atong i-multiply ang 15,000 shares sa 90 per share. So, ang iyang market value is 1,350,000. Next, if the quoted price pertains to a bond or debt security, it means percent of the face amount of the bond. So, here is another example. The investment of bond with face amount of 2 million costing of 1,700,000 is quoted at 90. So, atong i-multiply the face amount, which is 2 million, by 90%. So, ang iyang market value is 1,800,000. Gain and loss, financial asset at fair value. According to PFRS 9, gain and loss on financial asset measured at fair value shall be presented in profit or loss, except when the financial asset is investment in non-trading equity instrument and the entity has irrevocably elected or cannot be changed to present unrealized gain and loss in other comprehensive income. And second, when the financial asset is a debt investment that is measured at fair value through other comprehensive income. In determining fair value, no deduction is made for transaction cost that may be incurred or disposal of the financial asset. If the fair value is higher than carrying amount, the difference is the unrealized gain. If the fair value is lower than carrying amount, the difference is the unrealized loss. In other words, unrealized gain and loss on financial asset held for trading and other financial asset measured at fair value are reported in the income statement, while unrealized gain and loss arise from investment are reported at fair value. Gain and loss that are result from actually selling the investment are known as realized gain and realized loss. Gain and loss financial asset at amortized cost. Under PFRS 9, paragraph 572 provides that gain and loss on financial asset measured at amortized cost shall be recognized in profit or loss when the financial asset is derecognized, sold, impaired, or reclassified and through the amortization process. In other words, unrealized gain and loss on financial asset at amortized cost are not recognized simply because such investments are not reported at fair value. Illustration: Trading securities. On January 1, 2019, an entity purchased marketable equity securities for $5 million. The equity securities qualify as financial asset held for trading. The entity also paid $50,000 as commission to the broker. So we debit trading securities for $5 million and commission expense for $50,000, and we credit cash for $5 million and $50,000. The acquisition may be debited to financial asset or FVPL. FVPL means that the financial asset is measured at fair value through profit or loss. We also observe na ang commission paid sa broker kay wala gi-capitalize as cost of the investment pero gitreat siya as outright expense. Next, on December 31, 2019, the trading securities have a fair value of $6 million. The increase in value is recorded as follows. We debit of trading securities $1 million and credit unrealized gain TS $1 million. Ang unrealized income in trading securities giclassified siya as income statement as other income. So sa December 31, 2019, ang statement of financial position will report the trading securities sa iyang fair value amounting $6 million with a disclosure of cost of $5 million. Next, on December 31, 2020, the trading securities have a fair value of $4,500,000. The decrease in fair value is recorded as follows. We debit unrealized loss TS $1,500,000 and trading securities $1,500,000. So diri gi-report sa income statement ang unrealized loss as other expense. So pagka December 31, 2020, ang trading securities will have $4,500,000 and disclosure of $5 million. Sale of trading securities. On December 31, 2021, the trading securities are sold for $5,200,000. We simply record cash $5,200,000 and credit trading securities $4,500,000 and gain on sale of trading securities for $700,000. Under PFRS 9 provides that on the recognition of a financial asset, the difference between the carrying amount of the consideration received shall be recognized in profit or loss. Meaning, sa disposal of trading investment, ang difference sa cash received o sa carrying amount atong i-recognize as gain or loss sa disposal to be reported in our income statement. Another illustration in trading securities. On January 1, 2019, an entity acquired trading securities with the following market value on December 31, 2019. The ABC preference share had a cost of $200,000 market, $150,000 market, and negative $50,000 gain or lose. XYZ ordinary share, $800,000 cost, $950,000 market, and $150,000 gain loss. RST ordinary share have 1 million cost, 1,110,000 market, and 100,000 gain and loss. MNO bonds have 3 million cost, 2,500,000 market, and negative 5 million gain or loss. The total cost is 5 million and the total market is 4,700,000, while the total gain or lose is negative 300,000. The acquisition on January 1, 2019 is recorded as follows. We debit trading securities for 5 million and debit cash for 5 million. On December 31, 2019, the net decrease in market value is recorded as follows. We debit unrealized loss TS 300,000 and credit trading securities 300,000. Observe that the unrealized gain and unrealized loss are offset against the other, and the net amount is recorded this offsetting permitted by the standard. The statement of financial position will report the trading securities at fair value of $4,700,000 on December 31, 2019. and the notes to financial statement shall disclose the individual securities with their corresponding carrying amount and market value. On January 15, 2020, the ABC preference share is sold for 80,000. The journal entry to record sale is with debit cash 80,000, loss on sale of trading securities 70,000, and with credit trading securities 150,000. The difference between the sale price and the carrying amount shall be recognized as gain or loss to be reported in the income statement. On December 31, 2020, the remaining trading securities have the following carrying amount and market value: XYZ 950,000 carrying amount, 1 million market, 50,000 gain or loss; the RST 1,100,000 carrying amount, 1,500,000 market, and 400,000 gain or loss; and the MNO 2,500,000 carrying amount, 2,400,000 market, and negative 1 million gain or loss. The total carrying amount is 4,550,000. The total market amount is 4,900,000, and the total gain or loss is 350,000. The net increase in market value with debit trading securities for 350,000 and credit unrealized gain TS 350,000. The December equity investment at fair value through OCI. As stated earlier, at initial recognition, the entity may make an irrevocable election to present and other comprehensive income subsequent changes in value of an investment on non-trading equity instrument. So here, on January 21, 2019, an entity purchased marketable equity securities for 1 million. The entity paid commission and taxes of 100,000. Since the given problem is non-trading instrument, the equity securities do not qualify as financial asset held for trading. The entity made an irrevocable election to present unrealized gain and loss in other comprehensive income. We debit here financial asset FVOCI for 1,100,000 and credit cash 1,100,000. FVOCI means the financial asset is measured at fair value through other comprehensive income. Fair value through other comprehensive income. The commission and taxes of 100,000 are capitalized as cost of the investments. On December 31, 2019, the securities have a market value of 1,300,000. The increase in the market value is with debit financial asset FVOCI for 200,000 and with the credit unrealized gain OCI 200,000. The unrealized gain is presented as component of other comprehensive income in the 2019 Statement of Comprehensive Income. The financial asset FVOCI on December 31, 2019 is carried at the market value of 1,300,000 with disclosure of the cost of 1,100,000. The financial asset FVOCI is normally classified as non-current asset. On December 31, 2020, the security have a market value of 1,600,000. The increase in market value is recorded as follows. With debit financial asset FVOCI 300,000 and unrealized gain OCI 300,000. At this point, the financial asset FVOCI is carried at the market value of 1,600,000 and the total unrealized gain is 500,000. Nganong 500,000? Kay ang 300,000 kanina o ang 200,000 na unrealized gain kanina gi-add. Pero only ang 300,000 lang ang i-report sa 2020 Statement of Comprehensive Income. Ang total na 500,000 mo-appear siya sa Statement of Changes in Equity or sa Stakeholders' Equity. Sale of Equity Investment FVOCI. On July 1, 2021, the securities are sold for 2 million. The journal entry to record the sale is with debit cash 2 million, credit financial asset FVOCI 1,600,000 and retained earning 400,000. Ingon kanina sa PFRS 9, ang gain or lose sa disposal of equity investment measured at FVOCI or fair value through other comprehensive income is ma-recognize sa retained earnings. And also, ang cumulative gain or loss na na-recognize previously sa other comprehensive income will also recognize in retained earnings. Accordingly, the cumulative unrealized gain of 500,000 is transferred to retained earnings. So, we debit unrealized gain OCI 500,000 and credit retained earnings 500,000. The amount recognized in other comprehensive income is wala reclassified into profit or loss. So, here is another illustration. On January 1, 2019, an entity purchased marketable equity securities for 2 million. The securities do not qualify as financial asset held for trading. The entity elected to present changes in fair value and other comprehensive income. The journal entry to record is we debit financial asset FVOCI 2 million and credit cash 2 million. On December 31, 2019, the securities have a market value of 1,800,000. The decrease in market value is recorded as follows. We debit unrealized loss OCI 200,000 and credit financial asset FVOCI 200,000. Ang unrealized loss is gireport siya as a deduction as component of other comprehensive income sa 2019 and statement of comprehensive income. So, ang December 31, 2019 statement of financial position will report the financial asset FVOCI at market value of 1,800,000 with disclosure of cost of 2 million. So, on December 31, 2020, the securities have a market value of 1,300,000. The decrease in market value is recorded as follows. Unrealized loss OCI 500,000, financial asset FVOCI 500,000. So at this point in time, the total unrealized loss is 700,000. Giad ang 2 million diri sa una ay 200,000 diri sa una, tapos ang 500,000 karon. Pero ang 500,000 lang ang ma-report sa 2020 Statement of Comprehensive Income. Tas ang total amount na 700,000 moapira siya sa Statement of Changes in Equity. Sale of Equity Investment FVOCI. On July 1, 2021, the securities are sold for 1,200,000. The journal entry to record the sale is the debit cash 1,200,000 and retained earnings 100,000. We credit financial asset under FVOCI 1,300,000. The cumulative unrealized loss of 700,000 previously recognized is charged to retained earnings. We debit retained earnings 700,000 and unrealized loss OCI 700,000. These two entries can be compounded. So here is another illustration. On January 1, 2019, an entity purchased marketable equity securities not qualifying as financial asset held for trading. The entity elected to present changes in fair value as component of other comprehensive income. On December 31, 2019, the securities have the following cost and market value. Security A, 1 million cost, 1,100,000 market, and 10,000 gain or loss. In Security B, 2 million cost, 2,700,000 market, and 700,000 gain or loss. Security C, 3 million cost, 2,800,000 market, and negative 200,000 gain or loss. Our total cost is 6 million and total market is 6,600,000. Total gain on or lose is 600,000. Observe na ang unrealized gain and unrealized loss are offset against each other and only ang net amount ra ang gi-record. So obviously the increase sa atong market value dere is 600,000 and ang entry para ma-record nato ang increased net is financial asset FVOCI 600,000 and unrealized gain OCI 600,000. Sale of individual security. On July 1, 2020, Security A was sold for 1,400,000. The journal entry to record the sale is We debit cash 1,400,000, retained asset FVOCI 1,100,000, and retained earnings 300,000. The unrealized gain of 100,000 realized to security A as transferred to retained earnings. So we debit unrealized gain OCI 100,000 and retained earnings 100,000. On December 31, 2020, the remaining securities have the following amount and market value. Security B 2,700,000 carrying amount, 3,500,000 market, and 800,000 gain or lose. Security C 2,800,000 carrying amount, 2,750,000 market, and negative 50,000 gain or lose. Our carrying amount total is 5,500,000 and the total of market is 6,250,000 and total gain or lose is 750,000. The net increase in market value is recorded as follows. Financial asset FVOCI 750,000 and credit unrealized gain OCI 750,000. Unrealized gain December 31, 2019 is 600,000 and the unrealized gain related to security A that sold is 100,000. So atong i-minus ang duha. So ang atong adjusted balance is 500,000 and add na to ang unrealized gain in 2020 mukamap ta sa 1,250,000 cumulative unrealized gain on December 31, 2020. Simple approach. Actually, the cumulative unrealized gain is always the difference between the original cost and current market value. Security B, which is 2 million, security C, 3 million. I-add na to, total original cost is 5 million and the market value as of December 31, 2020 is 6,250,000 and the cumulative unrealized gain of December 31, 2020 is 1,250,000. Let's proceed to impairment, equity investment at fair value. For financial assets measured at fair value, all gains and losses are either represented in profit or loss or in other comprehensive income depending on whether the election to present gain and losses on other equity investment and other comprehensive income is taken or not. Therefore, it is not necessary to assess financial assets measured at fair value through profit or loss and equity investments measured at fair value through other comprehensive income for impairment. Now, in impairment in debt investments. According to PFRS 9, provides that an entity shall recognize expected credit loss on debt investment measured at amortized cost and debt investment measured at fair value through other comprehensive income. According to paragraph 553 provides that an entity shall measure the loss allowance for a financial instrument and an amount equal to the lifetime expected credit loss if the credit risk in the financial instrument has increased significantly since initial recognition. Credit loss is the present value of all cash shortfalls. Expected credit loss is estimate of credit loss over the life of the financial instrument. The amount of impairment loss can be measured as the difference between the carrying amount and the present value is estimated future cash flows discounted at the original effective rate.